All the news these days related to real estate are about how the market is going to crash. Will it be 2008 all over again? Are we going to see a lot of people becoming homeless due to a devastating market downturn? This question might be also on your mind. In this video, we're going to deep dive into the real estate market and look at factual data in order to understand where are we, what happens during a market crash, and where are we potentially headed to. First of all, we have to understand that the real estate market is not always going up. From time to time, like on the stock market, the prices will go down. The last time we've seen this was in 2008, when the prices went down by an average of 33% in the US. But that's not the only time the real estate market tanked. It happened again and again throughout history, for example in 1989, 1973 and 1953 as well. While studying the real estate market, different economists like Homer Hoyt in the US and Fred Harrison in the UK found that there is an 18-year property cycle. They've noticed that throughout history a new real estate market crash occurred every 18 years. The cycle starts with the recovery phase where the house prices start to increase again after a previous crash. It is usually caused by a combination of factors such as an economic recovery, interest rate reductions, or quantitative easing. This stage usually lasts for around 7 years and is characterized by rising prices, decreasing employment, and people feeling more confident about buying properties again. During the mid-cycle dip, the house prices are stabilizing or are even decreasing a bit. It is usually caused by a combination of factors such as an economic slowdown, interest rate rises, or even increased regulation. This stage usually lasts around 1 year. Next is the explosion phase where house prices go up rapidly. It is usually caused by a combination of factors such as low interest rates, easy credit, and high demand. A boom usually lasts around 5 years and is characterized by rapid rising prices, low unemployment, and people feeling very confident about buying properties. Sounds familiar? We'll get back to this. Of course, nothing grows forever, therefore the recession phase comes up next. This is the stage where house prices start to fall. It is usually caused by a combination of factors such as an economic downturn, interest rate rising, or overborrowing. This phase lasts for around 4 years. While there are some exceptions to this 18-year cycle, like World War II, most of the crashes followed this pattern quite closely. If we take a look at the last 3 cycles, we see how perfectly it fits this 18-year cycle. What's even more interesting is that each end of the recession phase stops at a higher price compared to the last one. In other words, yes, the real estate market is experiencing corrections each cycle, but long term it is going up. We can even go back to 1920 and see the real home price index increased long term. Of course, in this graph you see the home price index that takes into account inflation. In other words, in nominal terms, house prices increased even a lot more. Going back to the 18-year cycle, it is obvious that we are in the explosion phase where prices go up rapidly. We could expect to see growth anywhere between 1 and 3 years from now. However, you have to take into account that the 18-year cycle is more of a rule of a thumb and it can be 16, 17, or why not even 19 years. Trying to understand where are we in the cycle, we have to take a look at what happens in the market. In other words, we need to analyze the data we have and look from multiple perspectives. Just looking at an individual component like interest rates or building costs won't say much about the market as a whole and its future. In fact, if we look at interest rates and real building costs, we cannot see any correlation between them and the real home prices. For example, during the last recession in 2008, the real building cost increased, while the real home prices decreased. In the 80s, it was not the case anymore. While the real building cost decreased, the real home prices also decreased. The same randomness is also present if we analyze the evolution of the interest rates. From the 80s, the interest rates were constantly decreasing, while the real home prices went through multiple ups and downs. What happens quite often in the media is that they usually look at 1 or 2 indicators and then they write articles about huge crashes that are unavoidable. Unfortunately, this only scares people like we don't have enough going on in our lives. For example, I'm sure you've seen that the total housing inventory in the US is at an all-time high, hence some people started to freak out, calling it the biggest crash of them all. While this indicator is correct and it might indeed predict something, it must be looked at in a combination with the population growth. It's easy to understand that if the population grows, then obviously you will always hit a new all-time high housing inventory, as people need to have a roof over their heads. If we take a look at the evolution of the population in the US, we see that it also increased. The interesting part is that while the total housing inventory increased by around 10% between 2008 and 2022, the population grew by 33% during the same time period. This means that even though it's true that we have an all-time high for the total house inventory, in real terms it decreased as the population grew. And we could even go deeper by looking at the overcrowded houses, which also influence the market, but for now let me show you something even more interesting. Going further, I think it is very important for all of us to understand that when we analyze the real estate market, it is extremely important to have a top-down, three-step approach. The first step is to take a look at the market as a whole at the country level. This will show you the general trend. In short, will the market go up or down on average? The second step is to look at the state we are interested in. Even if at the country level the prices might stagnate, for example, in some particular states the prices might very well explode. Finally, we must dive deeper and understand what happens in a particular city where we want to buy our property in. Take a look at what happened in 2008. In the US, the average decrease in property prices between 2008 and 2013 was 33%. However, if we look at the state level, we see states like Nevada with a whopping 60% decrease. Arizona and Florida were also close with around 50% decrease. On the other hand, North Dakota has a shallow 2% peak-to-through price decline during the recession. The most interesting part is that this doesn't happen only in the US. If we take a look at Europe in different countries, we see the same pattern. Spain, for example, saw a big decrease in property prices during the last recession of around 45%. In Luxembourg, however, not only the real estate market didn't decrease, but the prices went up. Even during the recession, during the same period, 2008 to 2013, Luxembourg saw a 10% increase in real estate prices. But in real estate, prices aren't everything. The rent is extremely important for both investors and people looking to buy a home. For investors, it is obvious why rent is important. They want to have a positive cash flow after expenses in order to make money, and why not, maybe even afford new purchases. For home buyers, it is important because they decouple themselves from the potential growth of the rent, as of course, if they become owners, they don't need to pay rent anymore. This happens especially if they have a fixed interest rate. Again, when analyzing rents, it is important not to look only at the country level, but also at the state and city level. You can see, for example, that in Miami, the rent growth over the past year is around 23%. At the same time, the state of Florida increased by 18.3%, while in the US it increased by 12.3%. So, what can we do in order to protect ourselves from a recession? If you own the property in which you live, just don't sell while in a recession. You saw earlier in the video that long term the prices will only appreciate. So in the end, you shouldn't even feel the price drop which occurs during a pretty short period of time. If you are an investor, you have to look for the areas in different states and cities where 1. The businesses are growing, and 2. New infrastructure is being developed. The interest of people will always be in growing and well-served areas. Warren Buffett was saying about stocks that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This is also applicable in real estate. It's far better to buy a wonderful property at a fair price than a fair property at a wonderful price. Personally, when I analyze the real estate market, I look at tens of indicators like population growth, population migration, income per person, income per family, overcrowding rate, accessibility of real estate, interest rates, sales volumes, the change in outstanding residential loans, building permits, house completion, change in real house prices, total outstanding residential loans to GDP, and a lot more. As you see, the real estate market is complex, so you should use as much data as possible in order to analyze it. If you want to learn how to make money besides real estate investments, be sure to check out this video. You will learn how I became financially independent in only 5 years and how can you do it too.